Tradings are going great. I've been watching the market take a dip and we've been up. I think yesterday I checked, we were up 18% gross profit. I think we're up $6,000 on the month. So
At least if we're talking NASDAQ, 8.5%, Connor up 18%.
The best job by far. I can 100% with confidence say best job I've ever had. That's for sure.
Welcome back, everyone. Mark Anderson here, construction worker turned zero DT hedge fund manager. We're hooking up with Connor, and today we're going to show you the exact portfolio that Connor has returned 19% year to date on. If you don't believe us, you can see it here in Trade Steward. Another thing we will be doing with Connor is we'll go through his exact trades and portfolio. So Connor, how has trading been going thus far this year?
Tradings are going great. I've been watching the market take a dip and we've been up. I think yesterday I checked, we were up 18%. And I think we gross profit. I think we're up $6,000 on the month. So
yeah,
definitely an higher manny right now.
Yeah. So FYI, everyone is market down, at least if we're talking NASDAQ, 8.5%, Connor up 18%. We did have a little rough patch, but we're going to show you kind of how we've gone through portfolio. And, Connor is about to have a second kid. So twice the expenses. This is currently paying for his babysitter. So we're also going to be doubling his account next month. And we're going to be able to, cover those expenses of the monthly childcare there. But effectively, Connor's kind of graduated from the 30 grand account, and then we're going to bring him up to that 60 grand account. So the next part of that will be looking more at a portfolio. So the first thing we kind of brought up and I talked to Connor about last time was basically what is beta and what is correlation and how does that relate inside of a portfolio. So the easiest way we can basically go about to show this is what we're going to do is I'll show you a spreadsheet that I use in my personal portfolio and we will be using to display this to Connor. First of all, here's Connor's account. It's still live and updating here. He is running a few other strategies, but we'll start with the initial strategies that we've showed you guys here, and then we'll be building more in over time as we get to that larger account. So this is the portfolio sheet that we currently have for Connor. And basically what this does is you can kind of see on speed of how this updates. So we'll basically go into options Omega. We will take a portfolio. We'll just use SPX dailies for speed. I'm going to go to Connor's tab and we're going to take Connor's favorite trade here, which is the all in and open video. And we're just going to run a fixed one lot. So we have a little time to talk here, but you can basically see, Connor, how this takes a minute to run. This isn't necessarily the best use of our time to sit here and wait. And it's going to get exponentially longer for us to run this over time. And this comes back as you're time constrained, you have a job, you have kids, you have a family, this is not a great use of our time. And our constraint is basically the time we have to look at this. So this gives us the P&L, the CAGR, the max drawdown, and then some capture rate. So that doesn't necessarily help us that much, but I'm going to show you how we can speed this up. And you'll do this with the other trades that we add. So we'll export the daily net lit curve to Excel. Then when we go to Excel, we will open this up. We'll pull all of these dates. Then we'll go back to here. And you guys can see in our portfolio sheet here, currently, if we were to put in, a 3 lot of all in open, we get no numbers. Then when we go to strategy 1 and we input the net lit curve here, this spreadsheet will automatically calculate what our daily return is. And then it gives us even more insight on Sharpe ratio, average quarterly return, worst quarterly return, Sortino ratio, alpha, standard deviation. And you can see here that instantly we can change the numbers and all of these update very quickly in regards to that. I already have the other ones loaded in, but this basically shows how quick we can get the information, which in turn helps us do everything. So the next thing I wanted to do is I'll enter all 3 of these trades in, and I'll zoom in here so you guys can see it a little more. So we have roughly a 30 grand account. I did this with a fixed one lot at 100 grand, and then this will automatically scale if we change this, so you don't have to worry about compounding. But that means Connor would be running a 3 lot. He's running that 1045 Condor with a profit take. That would be a 3-lot. He's running his Monday curve fit with a 3-lot. And I did the same thing, but already uploaded this and all of the network curves here. So this would be a 3-lot, Friday 7 DT, 5 Delta put 3-lot, and then Monday 2-4 DC 3-lot. And this is 3-lot because he has a 30 grand account, but we just used 100 grand to make round numbers here. And then this will be the strategy that Connor's added. So first thing now, Connor, is what do you kind of see in here? And if you could explain what does this spreadsheet help you do basically?
So first and foremost, like this just came up to me as you were talking about this, but my biggest question when learning everything that you've taught me has been, all right, this trade is great, but how do I create a portfolio and like what trades do I decide to put in that portfolio? And this is a spreadsheet to do exactly that. It's basically the overarching picture of this is showing us how our portfolio is comparing against the market. And when I add a new strategy in there, it's showing us how do these strategies work together. So it's going to be able to show us what strategies work the best together and how are we going to have the best performing portfolios possible. And I think that just like, it's pretty cut and dry, but that's what I've gotten from it. And we're just, looking at the numbers, we're looking at the CAGR, we're looking at the max drawdown. You get to play with the lots to see like, if I bring it down to a 2-lot, it decreases the CAGR, but it also decreases the drawdown. So you kind of get to play with all those different options. Do you want to be more riskier to win more profit, or do you want to be a little bit more playing a base hit portfolio and having a lower drawdown as well? So that's just from playing from this. That's what I saw initially.
Yeah. And when we do this kind of, what a lot of people ask is people are always asking me about hedging and what's going on. And this is a prime example how when we have a small portfolio, we're just much better off basically hedging with our size and then hedging in regards to having different trades that aren't correlated. So we've kind of backed into this just for what I know, but now we're going to put numbers to it, which is going to enable us to add more trades. So the first thing I want to do is I want to go through the numbers with Connor, and I want to kind of talk through what each one means. So the first one I want to go over is basically these three, and we can think of it as a triangle where it's like there's beta, correlation, and then alpha. So just starting out with the first one, which we'll look at in this column and this column, is what is beta, Connor? Or what is your understanding of beta?
My understanding of beta is your stock. If the market increases 1%, how is your stock going to react to that?
Yeah. So a way to think of it is beta is how much you zig when the market zags. So we're always basically using the S&P. So if our beta, we'll just simplify it, is 0.5, Connor, and the market's up 1%, how much would our stock move?
That would be 0.5, right? Or would that? Yeah.
So it moves half as much as the overall index. Now, the next thing we have is correlation. What do you think correlation means, Connor?
That's the one I kind of understood how to get to correlation, but I didn't really understand like what that meant. Because I understand the beta, the market moves X, your stock moves X, but where does correlation play into that?
So the way to think of correlation is like it's how much you zig while the market zags. So the way to think of it is they're completely inverse. So if the market goes up 1%, you could have a correlation of 0.5 and you could be up 0.5% too. Or you could have a correlation of negative 0.5 and when the market's up 1%, you'll be down 0.5%.
Makes sense.
The way to kind of think of it is we'll look at it like a passing grade in grade school. So anything above a D or 0.6 is going to be pretty correlated. So it's like inverse. So if we're above a D, we're passing that we're correlated, and we don't want that. We want to fail on the correlation, which would make us uncorrelated. So anything below 0.6 is going to be of good value. And then anything above that is not. And inverse correlation, which a lot of people will be obsessed with the word uncorrelation. But if we're looking at something to actually protect us, we need inverse correlation, which would kind of be that minus part. And the other way these work too is if you can lower your beta and keep the same correlation, you're actually more diversified. So the example would be if we have a beta of 0.5 and a correlation of 0.5, if we bring down our beta to 0.3 and our correlation goes up to 0.6, we're still 10% basically more diversified in a better portfolio. Does that kind of make sense, Connor?
Yeah, that makes a little sense. It
So
can
can you
you
kind
help me
of
understand like
describe the relationship of beta and correlation to me? And then if beta goes up, what needs to happen to correlation or vice versa?
that's what I was going to ask you. So I was following along there, and then I got a little lost because you're saying like I thought like if beta goes up and we have a positive correlation, that means that our stock is probably going to go up as well. But what happens if the correlation is negative? You say you want a negative correlation, or do you want a
So
positive correlation?
the main thing is like we want to be below 0.6 because if I think everyone's had experience with this, but if you have kind of a normal job or whatever, and the stock market goes up 20%, sure, you have 20% more in your stock account and maybe you made 20% more at work, but houses are 20% more expensive. So if the market goes down and we can make money, like we have a correlation of 0.2, what the stock market does has nothing to do with us making money. So therefore, we'll have money when other people don't. But
Makes
the way
sense.
to also think about it is when the market's going up, like for example, Tesla has a beta of 2.7. So every percent the stock market goes up, Tesla goes up 2.7 times that.
Mm,
Which we can see last year and during the Trump rally, you know, Trump gets elected, market goes up 10%, Tesla goes up 50% or something ridiculous.
yeah,
Market goes down 8% this year, Tesla down 40%. So
makes sense.
what a lot of people mess up with that is that high beta is good in a bull market and it's absolutely terrible in a down market.
Makes
So
sense.
the other thing that this comes in with the triangle where it's beta correlation, then there's alpha. So alpha is our return above the market. So if we are half as correlated and have half as much beta, but we have no alpha, which is our return in excess of the market, we've just gotten less of a return than the S&P with less basically movement or correlation. So that doesn't really
Makes
help.
sense.
It's the opposite of Tesla. So if Tesla has a 2.7 beta and it has no alpha, you're just holding basically
What
a
the
more,
market is.
yeah, you're holding a more volatile version of the market. But if we have a portfolio that is, half beta and provides alpha, that obviously is a huge benefit to us. And the way to think of
Yeah,
it is if we have a triangle, think of there's beta correlation, then there's beta alpha, then there's correlation and alpha. And we're basically like turning the triangle over onto its side and then we're putting a seesaw on. And we want to get higher alpha with less beta and vice versa. And then we'll flip the triangle over again and then we'll have correlation and beta. And we want less beta and correlation and vice versa. So does that?
that makes sense.
Yeah.
So, like, my understanding is becoming this. So, like, if you have just a positive, if you have a super correlation, you're basically just running with the market. But if you have a lower correlation under that 0.6, like, you can still be beating the market when the market is losing, basically.
Correct. And the other thing to think of it is we can have a correlation of 1, but if our beta is 0.5 and our alpha is 1, would that be good?
Do those offset?
So let's describe it. So we have our correlation, which means the market goes up $1, we go up $1. But
Yes.
then we have our beta, which means when the market basically goes down by $1, we go down by 50 cents. You know what I'm saying?
Makes sense.
And then we have our alpha, which means if there's a return of 10% and we have, let's say, no alpha, we get 10%. So this basically means we're 100% correlated to the market, but we have half the drawdowns, and then alpha, we have the same return. Would
So
you
it
like
would
that
be
in your
good.
portfolio? Yeah.
Yeah,
Now,
so it would be. That makes sense.
yeah. Now try another example. Now we have really low correlation, the same beta. So a beta of 1, market goes up, we go up. However, 0.5, when the market zigs, we zag. And then we have an alpha of, let's call it 5%. Would that be good or bad?
That would still be good though because it still balances itself out, right? Since the correlation is lower and those two are higher, it's balancing it out, right?
Correct. Yeah. So the way to think of it is if our alpha is above 1 and our correlation is 1, we have edge over the market.
Makes sense.
As long as our beta is below 1. Then if our beta is below 0.1, if our beta is above 0.1, that means we need even more alpha. We need like 2 alpha for it to be worth it.
Makes sense.
Yep. So does that example with the triangle and like turning it over in the seesaw kind of make sense?
Yeah, you explaining. I think I had a confusion of like what correlation actually was versus beta, but now it makes sense. Like the correlation is when the market goes up, our stock goes up X, and it all kind of ties together. So that makes a lot more sense now, hearing you explain it all.
Yep.
So yeah, it says so as long as everything's kind of evened out, like as long as we're under 0.6 with the correlation, or if it's not, like the beta and alpha make up for it, then we're in a good spot.
Correct. And now the next concept I want to go by is knowledge and detail is power. So we can see right now our portfolio has, a beta of roughly what? Like you're kind of just guessing this, but
a beta of like 0.25, we'll just say
it's lower than that because we have 0.22 in 24, 0.04 in 2022, and then it basically doesn't even register in 2023. So we'll just call it like you'll 15. See it down here, 0.6 or 0.15. And then we have a correlation of 0.14 and 0.6. So our beta and correlation is pretty similar, which generally happens when we're running an orthogonal thing. But we're like 15% correlated to the market. So basically we have almost perfectly nothing to do with the market. However, we have 5 levers to change this. So if we take out these 2 trades, we can see that our correlation now goes negative. So that means that, and this is a concept I want to show people with 0DT. These are the 2 trades that we hold for longer than a day. They're not 0DT trades. So these trades are going to be the most correlated to the market. When we have these trades, we're 0.35 correlated and 0.3. Whereas when we're only having 0DT trades, we're not correlated at all. So does that kind of make sense?
Yeah, that makes sense.
Question for you, if we had really high correlation, which trades will we add size to?
If we had really high correlations, which trades? It would be to the ones that aren't correlated to the market, because we don't want to be super correlated to the market.
Correct. Right? And these are which ones? These are
the 0DT, zero DT trades. Yeah.
Okay. Now to further arm us with this, I also built out this sheet for us, and it shows the correlation and beta of each trade. And then I gave kind of some like highlights on correlation of these in relation to things. So looking at this, Connor, with correlation, what trades are most correlated and why do you think that is?
Which ones show correlation on this one?
So this is correlation right here. These are 4 trades. So you can see it. Here's all in it open. Here's the 1045 iron condor, Monday curve fit, Friday, Monday, and so on. So
the all in it open has a pretty high lower correlation, but still pretty high. And then the Monday D. And what was your question again, Mark?
Which trades are most correlated? I'm giving you a hint here.
These 2, the 10-15 and all.
Why do you think that is? Knowing that you kind of construct these, so all in it open goes at 932. When the VIX is up.
Yep.
And then 1045 goes on when the VIX is up.
Yes, because the VIX is, that's what I was going to say, is that they're going in when the VIX is up.
Yes. So we can see here that if we wanted to make more money, let's get rid of all 3 of these trades. So you can see our drawdown's 12.1 when we have these 2 trades on. And then when we add these 3 trades in, our drawdown's 12.5. So we're basically putting on these trades because they're so uncorrelated. If we look to this one, you have not correlated at all, 0.11 correlated and 0.6. So we can add size to these and the sum of the parts improves our whole. Whereas
that makes sense.
If we doubled the size of these, we have a massive drawdown.
Yeah, that makes sense. So the other ones were super correlated and on and open and at the 1045. So to balance that out, we're bringing in trades that bring down correlation.
Correct. And the other thing that I want to show is, you probably understood this before, where it's like 932 VIX up, 1045 VIX up.
Yep.
So we already knew we didn't want to add size to that. That's why I kind of hinted at you building these 3 other trades.
Yeah.
However, now that we have the numbers numerically, it gives us a good understanding of where we should add trades.
Yeah. That makes perfect sense.
That's, a good portion of it. Then some other things that I want to point out in regards to number is, do you know what a Sortino ratio is?
No.
Okay. Well, what a Sortino ratio does is it basically takes, I think I have the column in here. Daily negative return. So I'll scroll down a little bit. So here it's going to list all of our losing days. Okay.
Yeah.
So what Sortino ratio does is it takes all of your losing days and then basically divides it by the standard deviation, which is your average day.
Yep.
And then divides it by how many days are in a year. So what this ratio does is it says, if we're getting rid of capital efficiency, like let's say we have almost unlimited access to capital, this is how much money like we can kind of look at from a risk to reward ratio. So the higher this goes, the better risk reward ratio is. And now that we understand Bayesian correlation, that's already built out here. We have Sortino, which is kind of like our third one. And what I want you to do now is you'll come in here, and for each trade over the next week, I want you to be like, okay, all in it open. You'll go AIO 6.42. Then we'll look at Condor 1045 IC, and you'll see a 9.53 Monday curve fit, 1.4 Friday put, 1.08, and then Monday double counter. So looking at this, we have 1.47. So then this is maybe a little bit tougher of a concept, but I want to show this to you.
I think it makes sense. I'm not going to say, I want you to continue to explain it, but I think
the way to think about it is our 2 most correlated trades are our best performing. So looking at this list, what are the best performing trades by far?
The two first ones. And correct. I'm just going to take a shot and say the reason that's why we're having to size these as well. The ones that are, because.
And this is the concept here that I want to drive home is, so if you look at this, you look at these 2 and you go, if I asked you, how do we make more money? What would you think we do?
You'd plug more money into those 2, the first 2, the ones that have Sortino.
But triangle, the problem is these are correlated. So counterintuitive, these trades are like 4 or 5 times more risk efficient than these overnight trades. But when we add the other 3, it basically reduces, the amount of money. Yes. So you would think, oh, those are the best trades. Size them up. We get a 23% drawdown. But if we size these up, oh my God, we have the same drawdown.
Yeah.
So it's counterintuitive, but this is kind of in turn the entire concept that I want to bring home in is now that we have the spreadsheet, we are armed to make more informed decisions, which makes us better risk allocators. And by doing trades that are worse in isolation, you in turn build a better portfolio because of the uncorrelation. So this was the whole concept I was trying to explain, but now that we've had it pulled together. So now we're at this part. Do you have any questions for me in regards to that? And we'll just kind of have a little conversation here for 5 to 10 minutes.
Yeah. So basically is building out an entire portfolio is having like 1 or 2 super correlated ones that make you a lot of money, but having like 2 or 3, 4, 5, 6, 7, 8 ones. Like, is there like a ratio to correlated ones that bring in money and non-correlated ones that bring down our drawdown?
So the way to think of it is VIX opening up right off the open is a banger setup. Yeah. However, it's only one setup. And if we only have one tool in our tool belt, we're eventually going to get bit. And also that trade could fall out of favor.
Makes sense. Because if the market like starts taking a crap, it could start just not really going well. And if we're leaning way too heavy on that and we're contracting that up a lot, and that could kill our entire fund. But that's where I sprinkle into other ones.
Correct. And when we have correlation, one zags because it's bad market environments. The other ones may zig, and it'll help us get up. And the concept with this too is that as we put in more trades, as long as they're uncorrelated, it starts to matter less what the market does.
Wow. All right. That makes sense. Yeah, because I was going to say, is it even better to like just find more trades in this that they still produce good capital, but they have less of a drawdown. They don't add to the drawdown. They have a good under 10 drawdown.
Yeah. And another way to think of this too is it's like the vast majority of the benefit from diversification comes from 2 to 3 and 3 to 4. Like the example I give is like, how much harder would it be to go from having 1 kid to 4 kids?
True. It'd be a lot harder.
It'd be a lot harder, but how much harder would it be from going to 4 kids to 5 kids? Basically nothing. Yeah. They start taking care of themselves. You got an older one that looks at the other ones. It's fine. One of them gets hurt. It's no big deal. It's happened before, but that's kind of, logically the concept that we get when we bring these in. Now, next time for our homework, even though these numbers look great and we think we found this holy grail, the problem with our portfolio is that we are filtering out entries and we aren't able to execute the trades that often. So we have a large amount of data risk, being that we've looked for these perfect setups, and the more things we exclude and the more filters we have, the harder it's going to be to match those prior results. So I don't think we're going to get anywhere remotely close to those results over time because it's past data and we got rid of a lot of data. So the next thing we're going to look for is a trade that trades every single day with no filter. And we'll kind of break that down next time. And we'll come up with 2 of them, and we'll in turn compare them into the portfolio for that strategy 6 and see how they help us. And seeing what we've seen today, even a kind of shitty trade would probably help us a lot.
Yeah.
Yeah.
That makes perfect sense. Yeah. So I think if that brings it all in home, like the more you have uncorrelated trades, the more watered down it becomes, and you can just start adding more trades in there. It's not going to affect it that much.
Yeah. We're going to improve that diversification. Okay. You got any other questions, or does that kind of make sense where we're going on?
No, that makes perfect sense. Thank you so much for explaining to it. Yeah. I'm excited to have this tool and to be able to use it just to play around on how to add, when I find a new trade, to add it into the portfolio. So yeah, I'm all good on mine.
Yep. And then I will link this down in the description. And also, Connor's coming to town for an options trading boot camp in 3 weeks. So if you guys have any questions or any things you want to see Connor squirm through on that, drop in the description, drop it in the comments, and we will workshop that on YouTube. But I appreciate you guys for tuning in, and like, comment, subscribe, connect with me on LinkedIn. Always appreciate your guys' feedback because that's how we're basically making this. Thank you.